Yo, what's up, homies? It's time for the 8th episode of the Homeys Real Estate Podcast. This is your host, Anthony Luevanos, and today we got a good one for you. Our very first guest, it's my little brother, Angel Luevanos. Angel, you want to say hi?
Hey everybody, I'm looking forward to being on the podcast today and just sharing some basic information in regards to getting pre-qualified for a home.
Exactly. So today we got a good one for you. We're going to be going over pre-qualification. What is it? Why is it important? And then at the very end of the podcast, going over a mock interview or a mock pre-qualification. That way you set some good expectations, have an idea of what to expect once it's time for you to get pre-qualified. So with that being said, let's go ahead and let's jump right into episode number 8 of the Homeys Real Estate Podcast. So Angel.
Yes.
A common question that I always get, and I'm not a lender, I'm a realtor, by the way, but common question that I always get is, what is a pre-qualification and why is it important?
So first off, what is a pre-qualification, right? It's when you come down, whether you come sit down in person or, you can do it through Zoom, phone calls, several different ways of doing it. But it's basically essentially when a lender reviews your income documentation, they're going to review your credit report to see your credit scores. Along with that, they're also going to be able to see your liabilities and your debts. And then we're also going to want to review your assets, such as your bank statements, to see, first of all, how much do you qualify for, what your monthly payment is, and how much money is going to be needed when you purchase your home, down payment and closing costs, right? And as in regards to why is it important, I think kind of just like what I see a lot of people do, right, is they go and look at homes before they get pre-qualified, right? So they go out, they fall in love with the home, and they're like, oh my goodness, now I need to come in, get pre-qualified, do all those things. And they come in, and a lot of times, to be honest, they may not qualify. Or if they do qualify, hey, I qualify for $550, but that payment, which is about $3,100 a month, it's out of my budget, right? So it's very important to come in and figure out exactly how much you qualify for. Do you even qualify? If you don't qualify, what steps do you need to take to home ownership, right? So that's why it is extremely important. You don't want to start shopping without knowing all the information, such as down payment, how much you qualify for, and how much money is needed when qualifying for a home.
Preach, man. Oh my goodness. You hit it right on the dot. This is something that as a realtor, I have a problem with, right? Or I struggle to get my clients to do before they look at homes, because there's been instances where we look at homes that, we think in their price range, and then it turns out that there's some debts that they didn't know they had, or something that's on their credit that they didn't know. And because of that, they don't qualify for those homes. And we just spent an enormous amount of time looking at homes that they don't qualify for. And this is the last thing that we want to do, right? Is not only waste your time, but then set expectations and then have to reset them again. So, I always recommend, like Angel said, getting pre-qualified before you start looking at homes, because last thing you want to do is, waste time when you didn't need to.
And just to add on to that real quick, I do think it's crazy. Sometimes we run credit, right? And there'll be collections or there'll be certain debts, kind of like Andy said, that you guys as your borrowers, you guys don't ever really run your credit, so you don't even know it's on there, right? And then there's people who I feel like the number one fear is, I don't want to get a hard inquiry on my credit report. But it's essential to really becoming a homeowner. So if you're really serious about being a homeowner, it is essential to do that hard inquiry and see what are your scores, if your scores are there. And there's some people who know their scores aren't there, but they don't want to get the hard inquiry. But if you don't get your hard inquiry, you're never going to know how to fix your credit, how to get it higher, and how to, again, take that step closer to home ownership.
Yep, exactly. So another question that I commonly get is, what do you need to get pre-qualified?
So there's going to be 6 main documents. First is your ID, so driver's license, passport, something along those, government issued ID. Second is going to be your social security card. Third is going to be your W-2s for the last 2 years. Fourth is going to be your taxes for the last 2 years. Fifth is going to be your bank statements for the last 2 months. Number 6 is going to be your pay stubs for the last month. And then 7, if it happens, you happen to be in the situation, if you are not a citizen but a resident, a green card, and they just started allowing DACA to qualify for FHA conventional as well, we're going to need to see your renewal of what's it called, your work permit renewal. So those are just some documents those are the main documents, that would be needed for home ownership.
Gotcha. So something that I've heard lenders say is that there's a certain amount of work history required to get a loan. So can you dive a little deeper into that?
Yeah, of course. So there's going to be a minimum of 2 years required, right? So there's a way around it in the sense if you go to school, and for example, say if you're going to school to you're being a marketing major, right? So you go to school for business and you get a degree in marketing, and right after graduating school, you get a job in marketing, right? You are able to cancel out or skip those 2 years of employment and go straight into buying a home, right? You don't have to wait those 2 years of employment because we can prove that you got an education in that specific field. So you would just have to show documentation such as your transcripts showing you graduated with this degree, and then your employer is going to kind of verify that pretty much you got that job because of that degree, right? So that's a way around it. But if you don't have that, some type of degree, it doesn't have to be a bachelor's degree. It could be if you go to school to be a mechanic and you get some type of degree in that sense, that works as well. But if you don't, and you just have to establish a 2-year work history.
Yeah, okay, that makes sense. So something that I'm wondering, right? So there's that 2-year history that's required. Mm-hmm. So what if there's a break in work? Let's just say, like, for instance, during this coronavirus epidemic, right? A lot of people were working full-time jobs and then they were unemployed for a couple months and then they got re-employed again by their employer. Yeah. Is that going to affect whether they have to wait another 2 years to establish that work history, or how does that work?
Yeah, so great question. Kind of what you said. It's very common right now with the pandemic where people are losing their jobs, and it's taking time to reestablish, or to get a new job. So how does it affect you, right? So if you're unemployed for more than 6 months, you're gonna have to establish a 6 month work history once again, right? So that's gonna be the key. If you're unemployed for less than 6 months, so for example, I have a client right now who's actually in escrow. He got laid off from one job because of the pandemic. He found another job, I think 5 months later. So he was able right away to use that income. We just need to see 1 month of pay stubs at that new job, and along with an offer letter to get qualified for a home. He's currently in escrow and he's already got his loan approved. So it's definitely something that's possible. But again, if it's longer than 6 months of unemployment, you just have to reestablish that 6 month history again.
Gotcha, that makes sense. So as long as, like for instance, your client that only had a 5 month break and he got a job, right? Mm-hmm. Because he got a job in the same field, right? It has to be, if it's a different field, then you have to reestablish that 2 years of work history, correct?
Yeah, so I mean, it doesn't necessarily have to be the same field. It has to be pretty similar, right? But essentially the main thing the bank wants to see is that you're not going from, let's say, an engineer to a janitor, right? Where you went from making 6 figures a year to barely starting as a janitor. Let's say you're making $18 an hour, right? So you went from $40 an hour to $18 an hour. They don't want to see that decrease in income, right? They want to see continue with growth if possible, or somewhere in the same ballpark. If it's a lot less, then it's going to be hard to justify that for the bank, and you're going to have to most likely establish that 2 year history again.
Gotcha. So it doesn't have to be the same field, but just a very comparable field. But more importantly is the income, right? As long as the income's consistent. Gotcha. Exactly, that makes sense.
Exactly.
So, what down payment are you looking at in order to purchase a home?
So there's several programs that require different down payments, right? So most commonly, a lot of first-time home buyers ask, is there down payment assistance programs? I heard that there's programs that help you with your down payment from the government. That is true. So there's programs you can come in with 0% down, right? The most commonly used program by first-time home buyers is referred to as the FHA loan, Federal Housing Administration loan. It's a government-insured loan that requires only 3.5% down payment. The other program most commonly used is a conventional loan, right? Conventional requires minimum 3% or 5%. I recommend more. And then you can go so forth on 10, 15, 20% down. And then, of course, there's the VA loan for you veterans out there. I'm sure you guys know, 0% down, no mortgage insurance. Really, really great loan for you guys. You guys definitely deserve that loan because you guys keep our country safe.
Awesome. That's good to know. So what are closing costs? Because I know there's down payment, right? And then there's also closing costs. So you're going to have both out of pocket ready in order to purchase a home. So what are the closing costs and what's included in them? Like what's the what are the costs that are baked into that closing cost?
Got you. So closing costs are really broken up into two sections. First section is going to be companies that you pay for, right? For their services while you're in escrow. It's going to be three of them. The escrow company, which I kind of say is the referee of the transaction. They're going to make sure that the buyers are doing what they need to do according to their contract, and the sellers are doing what they need to do according to their contract, and making sure we close in that timely manner that it says on the contract, which is usually 30 days, right? So they're making sure of that. The second company that you're going to have to pay for is the title company. Title company is basically going to ensure that when you purchase your home, that it's going to be your home and that you're not purchasing with any liens, judgments, or there's any type of discrepancy when you receive your home. It's 100% going to be your name under your title, and there's going to be no trouble, anything to do with the previous owner, right? And the third one's going to be the bank. So the bank usually has two fees. One's a processing fee. Processors, what they do is they gather their documents you give me. I send it over to them. They put it in the file, put everything correctly. They're going to do verification of employments when you're in escrow. They're going to get all the documents needed from the title and escrow companies, just making sure your file is complete so you get your home and it's approved. And then the second people is the people that you have to pay for, is the underwriters. Underwriters are the people who approve your loan. So they're the ones that we're going to send the documents into. They're going to review them. And they're going to say, okay, everything looks good here. We're going to approve it, and you're good to go. You're going to get your house. So those are the two main people you're going to pay for the bank. So that's one part of closing costs. The second part of closing costs is going to be your reserves. So usually when you purchase your home, not usually, for sure when you purchase your home, you're going to have a certain amount of property taxes up front, right? So just that all depends on the month of the year you close your home. Right now, it's about 2 to 3 months. And then later towards the year, it's usually a little higher towards September, October, about 8 to 9 months of property taxes paid up front, right? So that's part of closing costs. And then you also have to pay home insurance some months up front, usually 2 to 5 months up front. So those are the main cost of closing costs. It's the companies you have to pay for to close your loan, along with the reserves needed. Combine those two together, that's closing cost. And closing costs, as far as how much is it, it's usually about 2 to 2.5% of a home. So to kind of give you quick numbers, $500,000 home, you're looking at closing costs of about $12,000, give or take.
Gotcha. Okay, that makes sense. And then for closing costs, are title fees included in that cost as well, or is that different?
Correct. Title fees are included in closing costs.
Gotcha. Yes. Okay, that makes sense. All right. So this gives me a pretty good understanding of what pre-qualification entails. What to expect. So now what I want to do for all my homies out there is a mock pre-qualification. So I want to go over a scenario where I'm the buyer, he's the lender, and my income as the buyer is $80,000 annually. My credit score is 680. I have 3 bills. I have a $500 car bill. I have an Audi. Love my Audi. So I had to splurge $500. $200 in student loans, and then $100 in credit cards. So about $800 in monthly debts. So with this scenario, Angel,
Yes.
What would a pre-qualification look like?
Yeah, definitely. So first things first, as a lender, we're going to analyze that credit score, right? 680, it's a good score, especially for if you're looking at an FHA loan. Great score. Conventional on the other side, I wouldn't recommend looking at that option. I recommend once it's over 720, it probably makes a little more sense. But since you're at 680, I highly would recommend an FHA loan, right? So with that being said, once we know your score, then we're going to go ahead and look at your income. $80,000 a year, that is about $6,667 a month, right? So we look at your income, looks great, and then we look at that debt, right? So that debt was $500 for a car, $200 for student loans,
Yep.
and then $100 for credit card debt. So in total, we are looking at debts of $800 a month, right? So it's pretty common. But I would say that's a good ballpark of what a lot of people do have. They have that car payment. If they don't have a student loan, they have something similar to a student loan or personal loan, or maybe more credit card debt. $100 worth of credit card debt monthly is not too much. It's not anything crazy. And again, these numbers we're looking at is not his total debt. It's his monthly obligations. That's what we care about at the bank. We don't care about if your car is $100,000. We care about what your monthly payment is, which is $500. So that's what's important to us. So with all those numbers, putting them all together, as far as how much you qualify for, you would qualify for about $520,000 with an FHA loan, right? Monthly payment, you're looking at about $2,950 a month. And that includes principal, interest, property taxes, home insurance, and mortgage insurance. All that is included in that monthly payment.
Gotcha. So for these monthly bills that I have, right, you're just going to be looking at my minimum monthly payment, right?
Correct.
Gotcha. Okay,
Correct.
so that's important.
That's super important. I think a lot of people, they like, oh, I have $30,000 in credit card debt. I'm not going to qualify, and I have another car I have a car payment that's $60,000. I'm not going to qualify. We don't care about, again, the amount of the debt. We care about the monthly obligation, the minimum payment, or the installment payment you have to make on a loan. That's what the bank truly cares about.
Cool. That's good to know. Okay.
And then, I'm sorry, one other thing I would say to that, we don't count cable bills. We don't count phone bills, all that stuff. Those debts aren't considered actual debts. Those are just bills that you have to pay. It's not a monthly obligation because you can cancel those whenever you want. So those don't count as debt.
Gotcha. So essentially anything that's tied to my credit score, right?
Correct. Yes, exactly.
Makes sense. Okay. So you mentioned that I was pre-qualified up to $520,000 with the FHA loan.
Correct.
So what down payment do I need? What closing costs am I expecting? What out-of-pocket costs should I be expecting for that home?
So on a $520,000 home at 3.5% down, down payment required, it's $18,200. That's the required money needed, either in your bank or someone's going to gift you the money. That money for sure has to come from you, the buyer, right? Closing cost again is about another 2.5%. So let's just say another $12,000 in total. You're looking at coming in with about $30,000 in total. Closing costs, as I know, I'm sure Anthony can kind of speak to, is it's not only paid. It's a requirement paid by you, but you could also have it paid by the seller if you negotiate it. Us as a lender, we could help you with some of the closing costs, sometimes all of it. But the bank never does anything for free, right? So they'll increase your interest rate to help you with those closing costs. But the down payment of that $18,200 is for sure has to come from you. No ifs or buts about it. And ifs or buts about it. Yeah, it's gonna come from you, the home buyer. Or again, if it's a gift, that's more than okay.
Gotcha. Okay, sounds good. So I didn't mention this, Angel, but this is my last month paying my car. It's going to be done. Would that influence how much I get pre-qualified for? And then if it does influence, what would that number be?
Of course. So that's a great question. So a lot of times people come in with debts and they maybe be at the end of their loan or almost done paying off their credit card, or they have some extra money hanging around at home or in their bank, and they say, okay, if I pay off this debt or if I pay off that debt, will it qualify me for more? Most likely it will. So let me go ahead and run those numbers for you if you were to pay that off, and let's see how much of a difference it would make.
Yeah, let's take a look at that, because I wanted to be somewhere in the $600,000 ballpark for like $575. I think that's the area that would give me more options for the 3+ bedrooms that I'm looking for in the area.
Got you.
Quick question as we wait. So in regards to the credit score, right? I have a 680 credit score. You're gonna be looking at the 3 bureaus and then getting an average of the 3, or how do you come across that 680? Which one do you pick? Which is the most important bureaus to be?
So again, like you said, there's 3 bureaus. Those 3 bureaus are Experian, TransUnion, and Equifax. We look at all 3 bureaus and we take the middle score. So just to kind of give you a quick example, if your Experian score is 667, your TransUnion score is 691, and your Equifax score is 680. 680 was the middle score between those 3 bureaus, so we would look at the 680 score. And then another question I get asked a lot is, if I bring in a cosigner and they have a 780 credit score, will that help me out as far as my credit rating? Unfortunately, the bank is always going to take the lower credit score out of the 2 borrowers It's just they want to mitigate the risk, so they always look at the lower borrower. It's not like a car loan where if you bring on a cosigner and that has good credit, you're going to get a better interest rate. That's not how it works with homes. We always look at the lower score between the borrowers. If you were to pay off that $500 debt, your purchasing power would go up to $550, right? And your monthly payment would also increase, of course, to about $3,100 a month. And with an FHA loan, I don't want to get too much in detail because it's a little tricky to kind of explain to someone who's new to this terminology. But we look at two different ratios, right? One's going to be the housing expense ratio, and one's going to be your debt to income ratio. Your housing expense ratio is how much of a monthly payment you can afford, right? So you get that by taking your monthly income and you multiply it by 46%. That is going to give you how much an FHA loan allows you to have maximum mortgage payment, right? So if you are making $6,667 a month and you multiply it by 46%, the maximum payment it allows you to have is a little less than $3,100. So you would qualify for about $3,100, right? And then you also have your debt to income ratio, which it allows you to have up to 56%. Debt to income ratio compares your total debts, including that new mortgage payment you're going to have, along with the income you make. So you could have 56% of it. So essentially, you could have no debt, right? So you could have some debt, and if you pay it off, you're not going to truly get to that new purchasing amount. I don't know if that makes sense. Like it's the max you can go is to that housing expense, right?
Yeah.
So the maximum housing expense, the maximum payment you can afford is $3,100. So you already reached that with your income. It doesn't matter if you have more debt. You've already reached the maximum limit you're ever going to be able to do right now with an FHA loan based on the interest rates of today. The maximum payment is $3,100.
Gotcha. So it's the smaller of the two, right?
The smaller of the two, pretty much, yeah.
So 46% or 56% debt to income ratio.
Correct.
Gotcha. That makes sense. So in this scenario, I would be pre-qualified up to $550,000 if I remove that $500 car bill. And the reason being is because I hit that 46% mark, right? Correct. So because I still have really low monthly bills of $300, it's more so my income. I need to start increasing that in order to get pre-qualified for more.
Exactly.
Or I would need a cosigner, right, to help me out.
Exactly. Cosigner, correct.
Gotcha. So like I mentioned earlier, I really wanted to be in that $600,000 price mark. So, and I guess what I would have to do is either come up with that money out of pocket or get a cosigner to help me out, right? Correct.
You could do out of pocket. We could also, of course, look at the conventional 5% down range. It's probably going to be around the same mark because, again, your score is at 680. If you get it up to 720, you probably qualify for a little more. But I would say the best route would be looking at a cosigner option that could help you, still come in with that 3.5% down. Your cosigner, if they own a home, they could still cosign for you guys. So don't think that they cannot cosign for you if they own a home. They're just going to be considered non-owner occupied cosigner, which essentially means if they own a home or if they have rent, we have to hit them. We have to count that debt against them, right? So we can't exclude that debt because they're still going to have to be paying that monthly obligation. But if you're only trying to get $50,000 more and you have someone who makes pretty good money, their mortgage payment's pretty low, there's probably a good chance that you could get to that $600,000 mark.
So this is a really important question, homies. The question is, I want to go the FHA route. I want a cosigner to help me get to the $600,000 price range. What if my cosigner is already has a home purchase with the FHA loan? Can they cosign on my FHA loan?
Great question. So most of the time it's no. You can only have one FHA loan at a time. The only way around that is there's like a distance rule. I don't know the exact amount, but for example, if you have you're buying here in California and you have a sibling that lives out in Texas that's willing to help you cosign and they have an FHA loan, because of the distance, that how far the homes are, it allows you you can exclude it, pretty much exclude that rule in that case because of the distance.
Wow, that's super interesting. I've never heard that before in my life. That's good to know, though. That's super good to know. It's something that probably worth exploring a little bit more, because I get that question often. So, okay. Well, now I know that I'm pre-qualified in this scenario up to $550,000 as of next month, and that I'm probably gonna need someone to help me co-sign, because I don't have that much for a down payment.
Correct.
But that gives me a really, really good idea, Angel, that right now, if I want to look at homes, I'm going to be looking at that $550,000 price range until I can secure a co-signer that will be willing to help me out to get to the $600,000 price range, right?
Correct.
But thank you so much, Angel. That really, really helps out a lot. I'm going to jump out of my buyer role and back into Anthony, the podcast mode, and just wanted to see, as Homeys, like, is there any questions that you would have for a lender? I know that there's a lot of financing questions I get all the time. I actually have a list of like 50 questions that I want to ask Angel, but I don't want to overwhelm you all right now. So it's something that I'm going to kind of batch up into separate little podcasts that I think are going to be very, very informational, educational, and insightful, and really help you all out. There's a lot of ways to get into your home. I know it can be overwhelming sometimes, but once you get a better idea of the certain scenarios and options available to you, you'll be more willing to actually explore them yourself. So with that being said, Angel, is there any last words you want to give to our listeners?
Yeah, I guess the main suggestion would be, I would highly recommend anyone who's truly interested in purchasing a home to come, not to me or to any lender you want, to go get pre-qualified and really see where you're at, right? Because a lot of times people are 6 months out to their goals or a year out to their goals, and you can figure out exactly what game plan to put in motion. Make sure when you do go out and you speak with the lender that they can help you build a game plan. I do know some lenders won't take that time, but make sure you find someone who's going to take care of you and make sure that they help you reach your goals. So just a quick example, I met somebody a year ago, about almost 2 years now. Literally, she called me last week. She said, I've been listening to what you're saying, and I really want to take this process serious. She's like, so I want to rerun my credit, see how it was. Her credit was like in the 550s. She worked on what I said as best as she could. She honestly thought she still wasn't going to qualify. I said, well, let's just run your credit. Let's see how it goes. She makes about $80,000 a year, a little bit more than that. And she qualified. Her credit score went up to 660. And she's ecstatic now. Now she's on that path to home ownership, and she's really, really close now. And it took her 2 years, but I know for her, she was extremely happy. So make sure you guys come in, get those questions answered, figure out a game plan, and make sure we can make home ownership a reality for you.
Awesome, Angel. Well, thank you for those words. Thank you, homies, for listening. I want to wish you all the best, and have a great day. Take care, y'all.
Thank you.
Hey, homies, it's Anthony. This podcast contains my opinions and is for educational purposes only. It does not guarantee any projections and should not serve as a basis for any purchase or sale in real estate.